What if I told you that Harry, a regular investor, discovered he needs exactly $2,376,238 at Fidelity to generate $5,000 per month in pure dividends? But here's what's wild. The number changes dramatically based on which Fidelity ETF you choose. Some investors need only $1.73 million. Others need over $5 million for the same monthly income. Same goal, same broker, completely different paths. And the ETF that requires the smallest investment might shock you, because it's not what most dividend investors typically chase. Quick note: this is educational content about dividend investing strategies, not personalized financial advice. All investments carry risk, including potential loss of principal. Past performance doesn't guarantee future results. Today, we're breaking down 6 Fidelity ETFs that could fund your retirement income. I'll reveal the surprising winner that needs the least capital, the hidden gem yielding over 3%, and why Harry's strategy might be completely backwards. Let's start with brutal math. $5,000 monthly means $60,000 yearly in passive income streams. That's what most Americans consider comfortable retirement territory. But here's where it gets interesting. At Fidelity, your path to that $60,000 varies wildly based on yield. Take FQAL, Fidelity's Quality Factor ETF. It yields just 1.18%. To generate $60,000 annually, you'd need $5,084,746. $5 million. Meanwhile, FREL, their real estate ETF, yields 3.46%. You'd need $1,734,104. That's a $3.35 million difference for the exact same income goal. Harry learned this the hard way when he started with the wrong ETF 3 years ago. He initially bought FQAL thinking quality meant better dividends. Here's what most investors miss about Fidelity's dividend growth offerings. The highest yielder isn't always obvious or best. FREL leads at 3.46% yield. But here's the devastating catch. It had negative 0.95% price returns over 3 years. Your income stays steady while your principal shrinks. FENY, the energy ETF, yields 3.11%, second highest yield in our lineup. But check this brutal reality. It returned only 3.04% total last year. That's barely beating inflation. Then comes FDVV at 2.98% yield. This is where things get fascinating, because FDVV delivered 14.66% total returns last year, nearly 5 times better than FENY despite lower yield. The yield tells one story. The total return tells the truth. Harry discovered this after losing money chasing yield alone in his first year. Let me show you exactly what capital you need for each ETF. For FREL at 3.46% yield, $60,000 divided by 0.0346 equal to $1,734,104. For FENY at 3.11% yield, $60,000 divided by 0.0311 equal to $1,929,260. For FDVV at 2.98% yield, $60,000 divided by 0.0298 equal to $2,013,423. For FUTY at 2.67% yield, $60,000 divided by 0.0267 equal to $2,247,191. For FDRR at 2.53% yield, $60,000 divided by 0.0253 equal to $2,371,542. For FQAL at 1.18% yield, $60,000 divided by 0.0118 equal to $5,084,746. Notice the exponential pattern? Every 0.1% drop in yield costs you roughly $70,000 to $80,000 more in required capital. But going from 2.53% to 1.18% costs you an additional $2.7 million. That's why yield optimization matters crucially in retirement planning. Harry now uses this formula before every investment decision. Expense ratios seem microscopic. FREL charges 0.08%. FDVV charges 0.16%. Double the cost, right? Wrong way to think about it. On a $2 million portfolio, FREL costs $1,600 yearly. FDVV costs $3,200 yearly. That $1,600 difference compounds over decades, but FDVV's superior returns obliterate this difference. Let's examine the real 5-year math. FDVV returned 122.97% over 5 years total return. FREL returned just 35.38% over the same period. On $100,000 invested 5 years ago, FDVV would be worth $222,970 today. FREL would be worth $135,380 today. That's an $87,590 difference. The expense ratio difference over 5 years? Just $400 total. Harry learned to look beyond fees to total performance metrics. He calls it the penny-wise, pound-foolish trap of investment portfolio management. Here's what nobody expects. FUTY, the utilities ETF, might be the smartest strategic play. Not the highest yield at 2.67%. You'd need $2,247,191 to hit $60,000 yearly. Middle of the pack requirement. But look at these hidden strengths. Rock bottom expense ratio at 0.08%. Paid dividends for 11 consecutive years without interruption. Delivered 15.02% total return last year. Plus something absolutely crucial for retirees. Utilities provide natural inflation protection. When costs rise, utility rates follow automatically through regulatory adjustments. Harry shifted 40% of his dividend portfolio here after understanding this. The stability completely changed his outlook on wealth building. Even better, FUTY's top holdings are monopoly-like businesses. NextEra Energy comprises 10.26% of the portfolio. Southern Company makes up 7.01%. Constellation Energy represents 6.67%. These companies have regulatory moats and guaranteed pricing power. Smart investors never choose just one ETF. They blend strategically for optimal results. Here's Harry's current allocation generating exactly $5,000 monthly. 30% in FDVV, $604,027, equal to $18,000 yearly at 2.98% yield. 25% in FREL, $433,526, equal to $15,000 yearly at 3.46% yield. 20% in FUTY, for $49,438, equal to $12,000 yearly at 2.67% yield. 15% in FENY, $289,389, equal to $9,000 yearly at 3.11% yield. 10% in FDRR, $237,154, equal to $6,000 yearly at 2.53% yield. Total invested, $2,013,534. Total annual dividends, $60,000. Perfect target achieved with diversification. But notice what Harry completely skipped? FQAL. Despite strong 16.05% annual returns, that pathetic 1.18% yield destroys the income math. Harry would need over $5 million in FQAL alone. Instead, he uses FQAL for growth in his separate investment strategy account. Dividend growth changes everything in long-term investing success. FDRR grew dividends an astounding 26.38% last year. That's extraordinary explosive growth. If maintained, your $60,000 becomes $75,828 next year automatically. FDVV grew dividends 16.01% annually. Still impressive for compound interest multiplication effects. But FENY actually had negative 4.36% dividend growth over 5 years. Your income shrinks while inflation rises. This matters enormously for retirement sustainability. A conservative 5% annual dividend growth over 10 years transforms $60,000 into $97,734. Without investing another single penny, Harry now prioritizes these growth metrics religiously. FDRR, 3 consecutive years of dividend growth. FUTY, 2 consecutive years of dividend growth. FDVV, 8 years of continuous dividend payments. The consistency matters more than current yield for long-term financial planning. Here's what absolutely devastates most retirement income plans: taxes. Qualified dividends get preferential federal treatment. 15% for most middle-class investors. 20% for high earners over $492,300. 0% for lowest brackets under $44,625. So your $60,000 might become $51,000 after federal taxes. State taxes could take another 5 to 10% depending on location. To net $60,000, you might need $70,588 gross. That pushes required capital up dramatically by 17.6%. FREL now needs $2,040,000 instead of $1,734,104. FDVV needs $2,369,000 instead of $2,013,423. Harry solved this with strategic tax-advantaged accounts. Roth IRA dividends grow completely tax-free forever. Traditional IRA defers taxes until withdrawal. 401k rollovers provide additional space. Strategic account placement saves Harry $9,000 yearly in taxes. Let's examine actual verified performance from the files. 5-year total returns tell an incredible story. FENY's 5-year total return, 210.17%, best performer. FDVV's 5-year total return, 122.97%, second best. FDRR's 5-year total return, 94.08%, solid middle. FQAL's 5-year total return, 90.44%, respectable. FUTY's 5-year total return, 66.51%, steady. FREL's 5-year total return, 35.38%, worst performer. Wait, FENY had the best 5-year return at 210.17%? But examine the recent performance. 1-year return, just 3.04%, terrible. 3-year return, only 18.91%, mediocre. 6-month return, 1.70%, basically flat. The energy boom already happened and ended. Harry learned timing matters as much as selection. Today's winner becomes tomorrow's laggard. Yesterday's champion becomes today's disappointment. That's why diversification across sectors protects your wealth-building journey. Most investors miss this absolutely critical retirement danger. What happens if you retire into a vicious bear market? Your dividend income might stay theoretically stable, but your principal could crater 30 to 40% immediately. Take FREL's actual devastating performance. Price return over 3 years, negative 0.95%. Price return over 1 year, negative 1.62%. Your $1.73 million slowly bleeds value, still generates $60,000 yearly in dividends. But psychologically and practically, watching wealth evaporate while needing income hurts deeply. That's why Harry maintains these crucial safeguards. 18 months living expenses in pure cash. Multiple ETFs across uncorrelated sectors. Quarterly rebalancing to maintain allocations. Never more than 30% in any single ETF. When real estate crashes, utilities often thrive. When energy collapses, technology might soar. This saved Harry during 2022's market correction. Harry didn't magically start with $2 million. He began with just $50,000 at age 35. Added $2,000 monthly for 15 years religiously. Reinvested every single dividend payment quarterly. Never sold during downturns. The accumulation math. Initial investment, $50,000. Monthly additions, $360,000, $2,000 x1, 180 months. Total cash invested, $410,000. Current portfolio value, $1.8 million. Annual dividends generated, $52,000. Not quite $60,000 target yet, but he's 87% there with less than 23% of target amount actually invested. Compound growth and dividend reinvestment did the heavy lifting. 3 more years gets him to target at current trajectory. Harry's secret? Consistency beats timing. Automation beats emotion. Time in market beats timing the market. To generate $5,000 monthly at Fidelity requires aggressive minimum, $1,734,104, all FREL, highest risk. Realistic diversified, $2 million to $2.1 million, balanced approach. Conservative safety, $2.5 million plus, maximum security. The exact number depends on 3 critical factors: your yield requirements versus growth needs, your total return expectations going forward, your risk tolerance for principal fluctuation. But here's the absolute truth about achieving financial independence. Starting today matters infinitely more than perfection. These 6 Fidelity ETFs offer distinctly different paths. FREL for maximum current yield despite poor growth. FDVV for balanced yield and impressive growth. FUTY for rock-solid stability and consistency. FENY for energy sector exposure and dividends. FDRR for explosive dividend growth potential. FQAL for quality companies but minimal yield. Harry combined them strategically over years. You can implement this same approach. The clear path to $5,000 monthly exists today. The math is irrefutable and proven. The ETFs are liquid and available. Your investment portfolio for passive income streams awaits. Your journey to retirement savings freedom begins with one purchase. Choose wisely based on data. Diversify intelligently across sectors. Let time and dividends build your wealth. Because at Fidelity, those monthly dividend payments aren't just numbers on a screen. They're your ticket to never worrying about money again. The freedom to live on your terms. Start today, and in 10 to 15 years, you'll thank yourself.